Welcome back to the channel. It's time we talked about the $85 trillion of hidden off-balance sheet dollar debt and FX swaps that the Bank of International Settlements, or BIS, recently covered in their quarterly report. Now, we put out a short video on this immediately when it happened because this was earlier in December, and now here is the longer form video, hopefully explaining more about what the heck FX swaps are, currency swaps, and why this is such an issue. FX swaps are exactly as it sounds. You swap one currency for another simultaneously while one acts as collateral. They bundle and package things up and they get more complex from there. So let's go through a quick example. Usually there is a swap bank in the middle and there's a company or firm on the left and a firm on the right. Let's call firm A, that's a US based business. And the firm B on the right is a UK or Euro based business. Both of those firms are domiciled in those countries. So in the USA on the left and on the right, UK. Now the issue is that they've got branches or establishments in the other country that the other domiciled in. So they need to, let's say they need to buy big amounts of equipment. They need to get cash. So this is how they do it. This is exactly as it sounds. This is a loan, and it's usually a higher interest loan, and the swap bank facilitates that. Firm A and firm B basically just swap currencies so that each one can then have the cash to go and buy the equipment or things that they need on their end. And so it's very strange that this is not considered a loan when that's literally exactly what it is. The money is exchanging hands. This has real deadlines. There's real interest rates associated with these things. And, at the end of the day, the loan is being paid off. A currency swap, which we will mention in this video as well, is just an FX swap with a longer maturity date. An FX swap usually matures in 12 months, and a currency swap is beyond 12 months. And there's usually a coupon that's exchanged. Now, in this case, it actually resembles a repo or a repurchase agreement with a currency instead of a security as collateral. Regardless of how you want to describe these types of loans, though, these are something that should not be considered a derivative, even though they are. They're not something that should be hidden or off balance sheet. They represent, like I said, a real loan, a real exchange of money and interest, and should be recorded properly onto a balance sheet. The $85 trillion in outstanding obligations to pay US dollars in FX swaps, forwards, and currency swaps is mostly very short term. It exceeds the stocks of dollar treasury bills, repo, and commercial paper combined. That's how much this is. The churn of deals approached 5 trillion per day in April of 2022. That's 2/3 of the daily global FX turnover. FX swaps, forwards, and currency swaps create forward dollar payment obligations that do not appear on balance sheets and are missing in standard debt statistics. Non-banks outside the United States owe as much as 26 trillion in such missing debt, up from 17 trillion in 2016. Non-US banks owe upwards of 39 trillion. More on this in just a minute. If we look back at the start of the data set in 2004, the BIS estimated that FX swaps was about 20 trillion. Now, if we fast forward to 2022 and look at that trajectory, which has essentially been straight up, we are now at 85 trillion. It's estimated there is another 15 trillion or so that's denominated outside of US dollars for a total of $100 trillion. Now, another interesting thing to note is that 80% of this US denominated debt is due to mature in the next year, as you can see in the chart in front of you. As I stated, much of this debt is very short term, and the resulting rollover needs makes for high risk of dollar funding squeezes. It cannot be stated enough. FX swap markets are vulnerable to funding squeezes. This was evident during the Great Financial Crisis, GFC, and again in March of 2020 when COVID-19 brought havoc to the markets. For all the differences between 2008 and 2020, swaps emerged in both episodes as flashpoints, with dollar borrowers forced to pay high rates if they could borrow at all. To restore market function, central bank swap lines funneled dollars to non-US banks offshore, which on-lent to those scrambling for dollars. The missing dollar debt from FX swaps, forwards, and currencies is huge, adding to the vulnerabilities created by on-balance sheet dollar debts of non-US borrowers. As I mentioned, it's reached 26 trillion for non-US banks outside the United States. That's double their on-balance sheet debt. And for banks headquartered outside the United States, dollar debt from these instruments is estimated at 39 trillion, more than double their on-balance sheet dollar debt and more than 10 times their capital. How does that equation work out? I don't know, time will tell. Keep in mind that we don't know who or which country these counterparties are from. And the counterparty group labeled other financial institutions comprises mainly non-bank financial institutions such as pension funds, insurance companies, hedge funds, but also includes non-reporting banks. Payment obligations arising from FX swaps, forwards, and currency swaps are staggering. Considering all currencies, outstanding amounts at the end of June 2022 reached 97 trillion, up from 67 trillion in 2016, as you can see in the chart we're showing on the screen right now. This matched global GDP in 2021, 96 trillion, and was 3 times global trade, which was 29 trillion. And it exceeded both global external portfolio investments, 81 trillion, and international bank claims, which was 40 trillion at the end of 2021. As we stated earlier, the US dollar dominance is striking in this market segment. As a vehicle currency, the US dollar is on one side of 88% of outstanding positions, or 85 trillion. It is estimated that 2.2 trillion worth of currency trades are at risk of failing to settle on any given day due to issues between counterparties, potentially undermining financial stability. The amount at risk represents about 1/3 of total derivative FX turnover and is up from 1.9 trillion from 3 years earlier when this last FX survey was carried out. FX trading also continues to shift away from multilateral trading platforms towards less visible venues, hindering policymakers from appropriately monitoring FX markets, the BIS said. So that means all eyes are on these bigger maturity dates where a ton of these swaps are up for maturity or payment to see how this all plays out. This is absolutely another black swan to watch out for and keep on your radar. As always, I'd love to hear your thoughts in the comments below. Thanks for watching. Subscribe and share it with a friend if you think that they're going to get value from it. We'll see you next time.